what are the covenants different in commercial loans that maybe new borrowers would need to be aware of, that maybe they don't think are a problem, that may be a problem down the road?
Okay, that's a good question. Generally, when one buys a property, buys a house and puts a loan on it, it is a non-recourse loan.
Mm-hmm.
It can become recourse once one refinances with a different lender.
Okay.
So buyers, borrowers, owners have to look very carefully at the loan documents to make sure that the loan is not becoming recourse. Because the recourse meaning it's personally guaranteed as opposed to just having the asset be the collateral for the loan.
Okay. That's for residential?
That's for residential.
Okay.
Residential loans also, in 99% of the situations, don't have prepays.
Okay.
So you get yourself a 3.5% loan and you think that you died and you went to heaven and you will never refinance for the rest of your life until rates become 2.5%.
Right.
You call up the lender and you say, we're refinancing. And the lender says, hot dog, let's do it. There is no prepay.
Right.
Commercial, on the other hand, you get a 10-year fixed rate loan. This is, let's assume for the first example that was 10-year fixed rate loan, home loan. You do a 10-year fixed rate loan from a lender, and there is a prepayment. Right. And they basically have gone out and either borrowed the money from the people who make deposits, or they have sold it in the secondary market, and they're expecting to get that return over the life of the loan. And so if you pay it off early, which you can, you must make them whole by paying the interest, which is outstanding for the rest of the term of the loan, less what the lenders can reinvest that money in, you guessed it, T-bills.
Wow, okay, so yeah, the spread you have to make up for.
So let's say that we do, on one of your projects, we do a 10-year fixed rate loan right now, and it's at 3%, and you are loving life.
Right.
Okay? 6 months from now, somebody comes and says, I love your property. I want to buy it. It's just perfect for my location. And I don't want a loan. I'm all cash. And you say, you gotta, if you have to have this property, you're going to have this property. And I will sell it to you. You pick up the phone, you call the lender, and you say, I need to pay off the loan now. Lender says, presuming it's in the loan documents, not a problem, Eduardo. Okay, your prepayment is going to be the difference between a 9.5-year treasury, when let's just say that would be 60 basis points, and the 3.5% interest. Let's just say it's 50 basis points because we can do it in our head. Okay, the 50 basis points, which is what a 9.5-year treasury would go for today, and the 3.5% coupon rate, that's 3%.
Yeah.
Times 9.5.
Yeah.
Right? Pay us back, it's not a problem.
Yeah.
Instead of taking your money and reinvesting it in other real estate loans, most loan documents give the lender the obligation only to reinvest in treasuries. Okay. So you're paying, after having that loan for 6 months, you are going to pay a prepayment penalty of about 25% of the loan amount.
Okay.
So you needed to have gotten a very good offer.
Yeah. That makes sense. That is something to concern.
Right.
One other thing that I was thinking of was, we were helping my uncles look for properties.
Right.
And one of the concerns was to get a longer term loan, and then there's a balloon payment at the end of like 10 or 15 years, even though it's a 25-year amortization loan. One of the concerns we always looked at was if the balloon payment was something that could easily be paid off if financing was difficult to achieve, or for whatever reason, just to have that safety net. So that was something else that we were looking at. Come meet us over at signetinvestments.com. There you'll have access to our full podcast and articles archives. Also, if you subscribe there, you'll get new updates sent straight to your inbox. You can also find us across all social media platforms. Our handle is Signet Investing. Thank you, and invest wisely.